The management of MedPlus joins us now. Mr. G Madhukar Reddy, Managing Director and CEO MedPlus Services. Mr. Reddy, good morning. Thank you for joining us. Walk us through the highlights for the quarter gone by. What's happened to the pharmacy business? What's happened to the in-house brand business, and how things really stack up?
Sure. The pharmacy business, typically Q1 is kind of slow for us. So if you look at it sequentially, we have actually degrown a little bit. But year on year, we have actually grown pretty significantly. Last year, we had EBITDA of around 2.6 on the pharmacy side and 2.3 overall for the business. This year, we're reporting a EBITDA percentage of 3%. And if you also take into account the money which we spent on advertisement this year, and that is primarily to increase the market penetration of the MedPlus brand, it should actually have been closer to 3.6. So that way, year on year, we have grown. I'm happy with that. On the private label itself, for us today, on volume basis, we stand at roughly around 13.9% of our overall sales comes from the MedPlus brand private label overall. And if you actually look at it, that is 17.5% of all the medicines we sell. For a new brand to actually grow to that level, it is obviously very encouraging for us. We feel that there's a lot of headroom for growth here, given the fact that countries like US and all, the store brands and what is sold by the stores typically is roughly around 80 to 90% of their overall sales.
When we spoke to you last time, you said that this whole idea of migrating into what really could be called as homegrown brands with a generic version is something which is going to be immensely profitable. How has that business progressed for you?
Yeah. So over the quarter, it has actually grown by roughly around 1.5% on net sales. Our net sales today stand at 9.5. When I say volume, that's volume mainly because our product basically sells at around 50-55% discount versus the normal product which sells at 20. So that's the difference. 9.5% of my overall sales on net sales is MedPlus brand. But if you look at it in volume, it is 13.9. So it has actually grown pretty significantly. And we're seeing this grow continuously across all the states in which we have actually promoted it. And the good thing is, it is not just the acute medicines we're selling. It's not just the headache, pain, and cough and cold and all that kind of stuff. Our brands are leading even in the overall diabetes, hypertension, BP, and everything else and all also. So across all therapies, our brands are now growing, which basically means that as the early adopters have come and they've actually experienced the entire set of products, as they continue to spread the word around, we expect a lot more people to join and this growth to become steadily, I would say, go steadily up.
I also want to understand, Mr. Reddy, you've already added about 37 stores in the first quarter, while your guidance is that to add 600 stores in FY25. Are you sticking to that, or are you going to make any changes there?
No, absolutely. So typically our growth is usually high in the second, third, and fourth quarters. Q1 is typically times when you are, kind of consolidating kind of stuff. And this year it is also, I would say, the problem. I would say the ability to grow was slightly, I would say, curtailed by one major thing, elections and all, where we saw a lot of people actually traveling back to their places. We had a lot of attrition during that time for various reasons and all. So that is the reason why we could not actually grow to the usual level. But that's not, when we guided to a 600 level, we had a lot of buffer out there. I don't think that will be a problem.
Okay. No, I asked because, in the past 12 months, your store addition has been at 469, whereas your peak annual addition is a count of about 1,000, 1,100 stores thereabouts, which you did clock from September 20 to July 23. So there's no shift in strategy, right? Where you're not being as aggressive?
Not, I would say, very significant. We have moved from 1,000 to a 600 store kind of thing out there. And that is primarily to make sure that we don't have to borrow or we don't have to get any additional cash. Today we have zero debt. We want to grow only, through our own internal accruals as much as possible, and if necessary, maybe take a small working capital loan. So we have basically said that, 6% growth is pretty good, and B, definitely be financially prudent out there and make sure that we don't have to borrow unnecessarily.
Right, and in the
That's all
private.
that is good. Yeah.
Good morning. Now, in the private label, you aim to achieve a 20% share of the total sales. Currently, it's around 16% already. Do you think that 20% in the next couple of quarters will be achievable, or what's the timeline?
So it's actually 13.9% of our overall sales and 17.3% of the medicine sales. So for us to get to the 20% of medicine sales, probably, a couple of quarters, but on an overall basis, 20% may take till the end of the year. It is, I would say the early adopters have come in. We have seen a lot of jump, but from here on, I think there'll be probably a period of stabilization on the growth. Maybe it'll grow at around 1.5% every quarter or slightly more. But yeah, that's the numbers I'm looking at.
Okay, thank you so much for taking the time out and joining in. That's the view coming in from the management of MedPlus, looking at higher promotion costs which impacted their margins, but most of the growth, according to them, is volume-led.